I'm a bit of background. I'm retired, sort of. A bit of advice: never retire. Literally, my third time. Don't retire. I'm off full time, but I'm on a few committees, investment committees, a couple of boards, a couple of companies, a couple of family offices, mostly Australian, Hong Kong, Singapore. But basically, my aim in life is to get people to think a bit differently. I'm not a career planner. I'm not a career advisor. I've done lots of things. I've got a CFA charter. I've got a few degrees. I teach CFA in the US. And I teach them in two ways. I say, look, this is what you do to pass exams, and then forget about that once you're passing. Now let's talk about the real world. So just looking at some of that stuff about retirement, you know, US is still going to the laddered bond during retirement, that sort of stuff. It worries me. Yes, you pass exams, but it ain't going to work in the real world, and we'll get into some of that today. So welcome all. That's me there. Bit of a, every slide, including BlackRock, so I'm good to see, starts with the idea of compulsory super. It's a dismal failure. 33 years of compulsory super, 11.5% of everyone's payroll goes in, and 2/3 are still on the welfare. Pretty poor. 2/3 are still on, 63% of Australians, this is 2022 numbers, ATO numbers, are still on the pension. It's okay, it's there, it's indexed for life. It's one of the few countries that has this great pension that's indexed for life. The US doesn't have it. Universal pension in Australia, so it's good. 2/3 are still on it. 37%, and we learned from Kylie's slide that most of those take it as a lump sum and pay off debt. So you're left with nothing, that's why they're on the pension. So pretty poor result after 33 years. Median age of, this is 2022 numbers, 2023 numbers, median age of retiring male or 64 right now is 212,001. That's it, and they use it to pay off debt. What have they got left? The pension. That's okay, it's there, take it, but that ain't welfare. That's not well-being. So that's a good starting point. Now, the other thing I should say up front is most of the discussion in this space about super. My attitude is, my experience has been that most of the wealth in Australia, fact-based, is not in super. Yes, it's 3.5 trillion. There's more money in business wealth. There's more money in property wealth, business property, housing wealth. Super's important, a good part of it, but it's not the entire realm of people's experience and people's wealth in dealing with retirement or succession or legacies or etc. So super's important, but it ain't everything. So I had this epiphany the other day, because I have a lot of talks, discussion with advisors, so I train advisors, I build courses, I do stuff, talk to a lot of them about what they're doing with clients and portfolio, 80-year-old clients, 20-year-old new starters, accumulators, retirees. First of all, how much do you need? What's your number? How much do you need? Now, the answer is 2/3 of Australia need nothing. They've got the age pensions. Indexed for life, be there forever. Probably will be some sort of pension in the future. Australia's had one since 1908. It'll always have one, I think, barring things going terribly wrong, which you never know. Then there's this thing called, you need about 10 times. And ASFA has this thing, you've all seen it, the comfortable lifestyle, 64,000 a year, and you need 640,000, so it's 10, works out to 10. There's a modest lifestyle, there's a luxury lifestyle, but it's not a bad place to start. So if you work on and every single bank retirement calculator, every single fund retirement calculator, almost every single one uses the same type ASFA approach, which is not bad if you're retirement. By the way, if you've actually been through that, the spending items one by one, you would kill yourself. But that's what Aussies have, their $64,000 comfortable lifestyle. I wouldn't last 2 weeks. Now, the other side of the coin is if you read any sort of research on this space globally, most of it comes out of the US, you've got this 4% rule. And you've all heard about it, you've read about it, lots of studies are done on it. It was built by an advisor called Bill Bengen in California. He looked at the US between 1926 and 76, and we'll look at that period he picked in a second, what that means and why he came up with this. US share bond mix, and he said a high probability of lasting 30 years if you have 25 times. If your budget's, a good starting point for conversations, $100,000. If you're going to spend $100,000 as your retirement spending budget, how much of that do you need? Or if it's 200, double it. If it's 50, halve it. So you per $100,000, what do you need? And the answer is, rule of thumb, 25. We can go through lots of ins and outs and 17 different conversations and trade-offs, which we'll go through one by one if you like. But it's not a bad place to start the conversation. If you want to be independent, you need something like 25 times to get a 4% spend rate. And we can argue about whether it's 3.5 or 4.5 or 5, and we'll get into some of that today. what it actually means is that depending on a lot of things, your needs, goals, circumstances, and also market conditions, we'll get to one or two of those in a second, will dictate each individual client's number. But the 4%, 25 times, not a bad starting point. So I'm having this debate over lots of forums, came from one this morning, about people talking about retirements, and you shuffle this and you shuffle that, you can do that, you can recontribution, do this paper shuffling in June 30, and I can get away with 6 times. And it dawned on me that there's this great difference in starting point and assumptions. This side of the page is building self-dependence, reliance on welfare. If you don't want to mind relying on welfare for life, don't want to help the kids buy a house, don't want to have any trust for the grandkids, don't want to have any play money for toys or fun or buy the boat or go on the golfing trip to Scotland, all that stuff, you don't want all that stuff, don't leave a legacy, don't want to build a PAF. My mother's 96, she's in her 4th nursing home. My dad died at 80, 12 years ago, and we had this debate. He had to have a RAD. You know, to go to certain, these things are expensive, so you couldn't come up with a RAD. They had to sell some shares because she was still living in the house and still was until last year. So she's spending about $160,000 a year on DAP and all the 4 columns, including the non-means tested column and all that sort of stuff. You know how it works. $160,000 a year. Now, fortunately, she's got a house, but had she had a dependent child or the husband's still alive, you can't just sell the house for the RAD because he needs a house. So these expenses really do mount, or can really do mount up when you get very old. Forget that, you're on welfare. This side of the page, which is where I live, you're selling freedom, independence. Forget welfare. So there's this movement in town in America called, there's some in Australia, there's a thing on tonight I'm going to on FIRE. 20-something, 30-year-olds are basically saying they put 80% of their salary into, they still live at home and mum washes the socks, that's another issue, and they save everything they can in order to build a pot by, say, 30, 35 years old and retire. So welfare's not in the corner for them. They're going to do it 20 years earlier. I call it FIRA, which is retire anytime, which is my goal. You do it if you like. You've got freedom. You've got choices. That's the world I live in. Not relying on welfare. Now, this is where I got this, people talking about this whole financial planning firms built around shuffling paper around June 30 to try and maximise welfare. You can do that. Most of the clients in Australia can't afford advice, so they're not in that game. Unfortunately, most Australians can't afford advice, so they're left to websites. My world is the right-hand side where you're building independence. It's a different mindset. How much do you need? I've got this chart, which is, it's all on the website. Basically, you start off with how much do you need. 2 sorts of clients. One client is pre-retirement, you think, how much do I need? What's the pot I've got to build? How much do I need to retire when I can start thinking about retiring? So you start with your expense budget, which, by the way, nobody has. Most people in Australia don't know. You ask them, they've got blank faces. So the first job that you all know with all your clients is come up with a sensible expense budget. But that's your starting point. That's a big exercise in itself. Let's per 100,000. There's a round number for the hell of it. Then if your spend rate is, say, 2, 3, 4, 5, 6%, multiply it out, that gives you your multiple. Same thing. This maths works backward. In retirement or out of retirement, you say, well, I can't go and work more. I've got my pot. How much can I spend? Same maths, except upside down. So I've got here as a sort of a starting point, rightly or wrongly, and we'll get into that. If 4% is your spend rate or 25 times is your sort of benchmark starting point, then you need, for $100,000, you're going to need around $2.5 million. You know, give or take. Then that's a starting point. Not just super, house, business, all sorts of other things. Farm, beach house. Or if you've got a pot of $1 million divided by 4, end up with 25. But the conversation is around independence, freedom, more so than about how you fiddle this pension rule to get more pension. It's there, it's a worst case, and sure, you can have it if everything else goes wrong. So it comes down to what is the number? Is it 25 or 4%, or is it 30, or is it 28, or is it 12? And the answer is it depends on what I found to be 17 factors. I will go through a couple of those. Like, for example, first one is age. My mother's who's 95. Now, if you start in the middle and you say, well, mainly if there's a midpoint there of, say, you know, score, I should have made this A, B, C, D, but if your score is sort of a 3, if you're 95 years old like my mother, she'll be up this side. She needs bugger all. We've sold her out of the super to save the death tax, and she's sitting on cash, spending $160,000 a year in a nursing home. She's 96. If you're 30 years old, you need a lot more than that, of course, because the Bengen rule only works for 30 years, And it only works in a specific 30-year period, 50-year period you looked at from the 20s to the 70s. So it may well be more than that, as we'll get to in a second. But the point is, each one of those, your likely lifespan, each one of these, willingness to ability to downsize the family house. If you've got a family house or farm or beach house you're going to use, obviously you need less in your pot because you're going to supplement that. Other assets, flexibility. So there's a lot of factors we'll go through in a second, all of which are age, lifespan, downsize, other assets, income flexibility, expense flexibility. What that means there, I run charities and foundations portfolios where you've got, for example, a hospital. Let's say there's a bad year in the market, you've got to draw down 5%. You can't put off a third of your staff in a bad year. You've got very rigid expense budget. Other people say, like my own expense budget, we're going on a cruise to Canada and US in October before the election, and if it's a bad year, we'll go next year. Some things you can't put off, car breaks down, fridge breaks, some things you can't put off, but a lot of people have some flexibility in the expense budget. Lumpy capital needs versus smooth capital needs, withdrawal pattern, whether you're withdrawing a set percent or a particular dollar amount index, that will make a difference on how much you need. Income tax drag, Division 296, what's it going to do? A lot of people are pulling money out of super and putting it in other entities, companies, trusts, etc., giving it to their kids. So a lot of that will depend, tax drag and also fee drag. The higher the fees, the more you need. Estate, do you want to leave an estate? Yes or no? Makes a huge difference. If you don't want to leave an estate, you've got no kids, no interest in life, then it makes a big difference. Willingness to eat into capital. A lot of people, I'm one of them, who just can't bear the idea of eating into capital. If that's the case, and it's an emotional need, not a financial need, it's an emotional need, then that makes a big difference to how much you actually need to support that emotional goal. Risk tolerance, of course, that drives your AA, asset allocation. If you're in cash and bonds, you'll need a lot more than if you're in growth assets. So your risk tolerance will determine your asset allocation. Expense inflation, future inflation, we'll cover some of those. The first one is your age. And this is where the idea is to start people to think a bit differently about their age and life expectancy. We'll take both of these. We've all seen those charts. Basically, this says, today, this is Life Tables June 30 last year, a 30-year-old today, male, female, life expectancy is 82, 86. So me, I'm 65, so my life expectancy is 85 if I was male and 87 if I was female. And nowadays I've got 5 choices between male and female. 80 years old, so I can pick and choose, you see. So it goes up. Why does it go up? Because the longer you live, the longer you're likely to live. When I turn 90, my life expectancy will be a lot longer than it is now. The problem is, and this is where people start to get a bit concerned, is that those figures are median. Half will live longer, half will live less. Some people will die tomorrow, unfortunately. And some people of that cohort today will live a lot longer. The median, you can't plan on the median because what if you're in that half that lives longer? So I say, rather than look at the median, you can look at a survival probability curve. So in my case, I'm here, I'm a 65, well, let's take a 60-year-old. Their median life expectancy right now on the ASX, on the ABS life tables, is 85 males, 87 females. But that's just a median. There's a 50% chance they'll live longer to maybe 100, 110. There's some of them will die tomorrow. I've seen you go out the front. He'll go under a bus and go. But for every day you're older, the chance your bell curve moves to the right, let alone improvements in medical technology and vaccines and health and nutrition. Every day that you survive, your bell curve moves to the right and you're in the survivors, so your bell curve moves along. So that bell curve is moving to the right all the time. So I tell people, look, there's a good chance you're going to be one of those people who live to 100. My mother's 96. Her life table says she'll live to 101. And that's just the median. What if she lives longer? So what I do is you can plot your family on this. Now, the beauty of the ABS is you can look up the ABS site right now and get the yearbook from your date of birth or your grandparents' date of birth or your mother's date. The yearbook on the ABS, they're there from about 1901 onwards. And you can look at your life expectancy at the time you were born. So in my case, I can plot me, I'm there 65, so my curve looks like this. So probably I'm 87, my median's there, but I'm probably going to live, I'm hopefully going to live longer. I can still, everyone thinks they're more healthy and more fit and their nutrition's better than the next guy. So they're all, it's like driving. Everyone thinks they're better than average driver, but they can't obviously be better than average driver. But everyone thinks they're going to live longer than that. If I died at 85, I'd be very disappointed. I'm planning on living a lot longer than 85. So my probability curve's there. My brother is there. My wife's there. I keep telling her she's on that curve. Every day she survives, her bell curve goes to the right. My 30-year-old daughter there, my 24-year-old son. My brother killed himself in a plane crash he was flying at age 51, about 12 years ago. My father died in 2012. He was 80 years old. But for the survivors, my mother's here. She probably lived 105, 110. Median says 100, but that's only the median. You've survived so far. So this is the problem. Forget about medians. Think about you and your clients. What if they're in the 50% that live longer? So you can do this exercise. My mother, born in 28, I looked up the 1926 yearbook, which is the one previous to her, but there wasn't one in 1928. Page 971 says her life expectancy of birth was 63. She's now 96 and the tables now say 9. So her curve has moved 3 decades to the right in her lifetime. My father, 1942, born in Malaya, bombed out, Japanese occupied. His life expectancy of birth was probably about 40 or 50. He died at age 80, so he lived, his curve moved 3 decades to the right. Me, I was born in Singapore, middle of the revolution, should have died at birth. If I was born in Australia, which I've had the benefit of the health and nutrition and everything else in Australia, which is good, thanks very much. If I was born here, my life expectancy in the 1959 yearbook was 67. I'm already 65 and my tables now, so I've already moved 2 decades. So the point is, forget life tables. You're going to move, your curve is probably going to move 3 decades-ish and your clients over their lifetime. So the bottom line is, planning application, assuming it moves. Natural, nutrition, healthcare, vaccines, medical technology. Client application is, what I say all the time is to clients, first of all, rule is always get them both in. And you always know that. Never talk to the male alone, always get them both in. Because she's probably going to die a lot later and she's probably a lot younger to start with. So always deal with John and Jill together. And then I say to them, one of you is going to live to 100 and Bill, it ain't you. It's always the wife. So even though he might have made the money in and managed the money and looked after the money, it's the wife's money because she's going to live 20 years longer, so it's her money. So one of you is going to live to 100. Even if you're 60, 70 years old. So forget about this little, laddered bond portfolio, which is just nightmarish madness, you'll get to see in a second. Plan on a 30-year, 40-year time horizon, even if you're 70 years old, because what are you going to live to 100? And that's if you spend the last cent of the day you die. What if you've got a bequest wish? What if you've got an estate wish? What if you've got a PAF? You've got to think about these things. So portfolio management is, basically you're looking at a 30, 40 plus year, which mathematically is no different to running a perpetual fund, which I do for charities. Just assume it's going to be there forever, because it will be. 30, 40 years is forever. So that's scary stuff when people are looking at these life tables and laddered bond portfolios. It's just nightmarishly scary. You've got to think 30, 40 years, which means, moderate growth portfolios, forever. Or at least until they're 96, like my mother. So the second one is, a lot of your how much do you need, how much capital do you need, how much you can afford to spend, are outside your control. And two of the last ones are the inflation environment. Now, I've looked at 100 years, 124 years of returns, this is the end of last year, and you look at all the main asset classes. This is Aussie dollars, and you look at the returns, real returns after inflation, total returns. So shares, US shares, global, Aussie shares, you're going to get around about 6.5% real returns, total returns from shares, have done forever, centuries, through all sorts of conditions, wars, all sorts of things. Housing's been not bad, listed property, Australian government bonds. So at the bottom of the curve, you can expect cash earns bugger all above inflation. So the real return from cash has been 1%. That's all years. Then you split it up into high inflation years, which is where Australian inflation is above 5%, moderate, where it's between 2 and 5, sorry, high inflation where it's above 5%, low inflation, it's between 0 and 2 or negative and 2, and moderate, where it's between 2 and 5, these are the returns. So the last 40 years of our life, we've all got rich on low inflation. We've all got rich. We've all done very well. The fact that inflation's been declining and low for the last 30, 40 years, it's benefited all because we've been living here. We're about to head into that or that. So the real returns you can expect from a portfolio, if the world of low inflation is gone, ZERP, QE, etc. is gone, we're now into a re-inflation world, which is a generational cycle. So all asset classes are significantly higher when inflation's low. Thanks for that, we're all rich because of it. It's been fantastic. It's just pure luck of birth, just pure lottery of life when you're born. We benefited. Returns from all asset classes are lower. The problem is there's no inflation hedge. There's no such thing, even gold. I've got precious metals, by the way. I've got gold, which is my mix of gold, silver and platinum, because for most of that period gold was illegal. So I've got silver and platinum, which are proxies. Try and build a CPI plus 4 portfolio out of that, and it's physically impossible. It's okay now, we've lived through that. We've got CPI. In fact, anybody who invested in anything over the last 30, 40 years did well after inflation. It's impossible physically, geometrically, to build a portfolio if you think you're heading into a moderate-ish and high inflation. You can't do it. Shares are returning you, this is before fees, 4-ish%. Cash, bonds, etc. at the bottom, precious metal is 0 or negative. So you can't build a portfolio to last my 30, 40 years given the inflation outlook we're currently looking at. Why is that important? If you look at, this is my short-term picture of inflation, inflation cycles this is 5 countries, and this is not yearly, this is average 5 years, so it ignores COVID. This is just purely average 5-year rolling inflation, so you forget the one-offs and wars and stuff. Rising over time, we've just been through this fantastic period of deregulation, globalisation, end of the Cold War, cheap fossil fuels, immigration, all that stuff generated low returns, low inflation. We're now back into monetary expansion, protectionism, self-sufficiency, re-regulation, trade wars, military build-ups. Guess what? We're into inflation. So the textbook approach, all the textbooks, including Bill Sharp and all the guys you mentioned, they all wrote and got their PhDs there when the world was different. That was a low inflation, declining interest rate world, which generated fantastic returns. You and I know that's gone. We've now got to build 4 portfolios. So that's when I say assume that your low inflation world is gone. Pretty hard to argue with that. Therefore, nominal real returns from all asset classes, including precious metals, particularly bonds, are going to be lower than the past 30, 40 years of boom time. And therefore, you need more capital to be safe. So it's scary stuff. So that's the other one, which I won't go into, which is all I've written about. Basically, the second non-negotiable, because inflation's locked in for everybody. So forget about your goals and needs. That item 6, 7 to 16, which is inflation, lock it in as a more capital required because we are heading into a moderate inflation world, no longer a low inflation world. The one here I will touch on briefly, won't go into it, is the fact that markets are expensive now, real estate, shares particularly, bonds even I would argue are expensive, even at 4%. The fact that markets are expensive now, particularly growth assets, means that the future returns are more likely to be low, and therefore, guess what? You need more capital. So even though you say, well, your starting point's 25 times 4%, goals and needs of individual circumstances will dictate a lot of that. Do you want an estate? Do you want to leave a legacy? Do you want to give money to your kids? Have you got other income, other assets? But these two at the bottom, the fact that markets are expensive and the fact that we're heading into a moderate inflation environment, they're given for everybody. You can't touch those. They're locked in. So you can have conversations about the 17 things, the 17 questions, but some of those are already locked in. I won't go into those. Those last two, the fact that future inflation, you're probably locked into more capital required already, and the fact that equities are expensive now, particularly even real estate and alternatives are expensive now. Even infrastructure, they're bond proxies. Property, they're bond proxies. Given that bond yields are rising, they're probably already locked in. So the other conversations of the 17, 15 of those are about client needs and goals, individual circumstances. Those other 2 question marks, they're already locked in. So prepare for it. Otherwise, you're going to get some very angry clients in 20 years' time when they come back and say, well, you told me. Well, bank on running perpetual portfolios, which are growth-ish portfolios with lots of assets in them, diversified, but assume they're going to be there for 30, 40 years, which means, balance-ish growth portfolio. So it's very different to textbook stuff, which I teach, and I say, forget about that, pass the exam, now let's get on with the real world. This is how the real world works. That's all I've got to say. Thanks for that.